Welcome to My Financial Coach Live.
All right. Thank you all for joining us for My Financial Coach Live. Today we have a very special guest in our studio. And today our topic is actually going to be on student loans. There's been a lot of interesting developments from the Secure Act 2.0, making considerations all the way to recent student loan repayments being required. And so today we have our guest, Chris, who is with us. And Chris, would it be possible for you to give us a brief introduction of yourself and your background?
Chris Pfanstiel here. We run a small financial planning firm in Pittsburgh that focuses on planning for physicians. And so in our day-to-day work, it's really normal that a physician feels a little bit of a drag or concern or fear about what on earth to do with their student loans. So we've specialized in working with loans. We've onboarded some talent who's really wonderful at focusing on loans as well. And we do our best to not only educate, our clients on what they need to understand about loans and their options, but we also try to tie those into their planning, because quite frankly, it's hard to feel like you have a financial plan that doesn't take that 200 or 400 or whatever it might be, $1,000 problem into account. So about 15 years now, I've been in the industry, and the last 5 at our own firm. And over the last 10 years, our expertise around loans has really been refined into how it applies to physicians.
So Chris, thank you for that background. And just to set the stage for our conversation, as many of our listeners are not just physicians, but high-income individuals, either in the past they have had student loans or currently do have student loans. Some of them are now actually making these decisions with their children as well. And if many of them have not saved for that, it's going to be one of those things where, well, do you stop saving for retirement and some of these other things to now help your children with the burdens of their education? Or, hey, does it make sense for us to help them look at different student loan options? But ultimately, all of this culminates in the student loan discussion. Chris, just based on your expertise, what are some of the if someone does not save for their children's education, and ultimately, they have to take out student loans and they've accumulated. What are some of the balances you're seeing? What are some of the strategies that people, especially those that have high balances coming out of medical school, what are they looking at?
Typically, the highest balances are going to be centered around federal student loans. And federal student loans have several programs which seem to be ever changing and evolving. So even if you watch this today and then you circle back to it 6 months from now, the rules might be different, but the themes are going to be pretty consistent. There's a ton of benefits in federal student loans. There are protections that help you experience a repayment plan that's going to be a percentage of your discretionary income. And those repayment plans might, depending on the ones you select, they might have caps where no matter how much money they make or the borrower makes in the future, the payment doesn't have to skyrocket. A lot of them might have interest subsidies. So the effective interest rate that someone actually experiences might be a lot different or a lot better than the interest rate that's stated on the loan. And some of these programs lead to forgiveness in just 10 years if you work at a nonprofit, or maybe 20 or 25 years if you work at a for-profit. So when we walk through federal loans where the balances are usually the highest, when you ask a question about folks with expensive tuition and a lot of loans, when we walk through federal loans, it's important to understand all of the perks or benefits that might be there. And if we understand those perks or benefits, maybe the knowledge curve is intimidating, but the repayment plans aren't necessarily intimidating. We just have to understand them well. And so I would say everyone needs to spend some time getting to know all the rules around their federal loans, and then they'll feel more prepared to tackle them.
So you bring up federal loans, so that's a good point. Federal loans are encoded certainly in law, some of it, but there's actually been a lot of executive decisions and bit of whiplash for borrowers as different programs go through different iterations and different pay, repay, save. What are you seeing in the landscape? What is the direction, either based off of how the programs are reconfiguring, and do you feel that any of it might change, and what parts might change? Do you hear any rumblings?
So we do hear rumblings. Predicting the next move on student loans feels like predicting the next move of the stock market. It's going to trick us all a little bit, but the themes are this: PSLF was made and it was relatively poorly executed. So when I say PSLF, Public Service Loan Forgiveness, to be clear, that was made and it was relatively confusing, huge amount of error. Servicers had errors, as did a lot of borrowers. They've done a great deal of work to simplify it. They've done a great deal of work to take servicer error and give you a way to go back and make some of those things count without a cost to you. They've even gone back and found ways to say you can repurchase some of your service. Now, that having been said, the theme over the last few years has been, let's fix it, let's make it more doable for borrowers, let's simplify. The theme with the present administration has also been, let's lower the cost, whether it be the interest rate or efforts to just get rid of $10,000 or $20,000 of balances, or lowering how payments are calculated through SAVE. It's also been giving bigger interest subsidy through SAVE. So the present administration has kind of shown what their motivations are, that there's a clear reduce the cost initiative there. When Trump was in office, let's say that there's a change in the guard and it's a Trump administration. When he was in office, he and I believe it would have been Trump with Pelosi as speaker, had several budget iterations that talked about discontinuing public service loan forgiveness, but not discontinuing it for folks that are already in the program, discontinuing it for folks that have not yet taken out their student loans. Now, that conversation never even gained traction. However, it was brought up in parts of several budgets. What I would say is, for folks that have already borrowed money, the rules are going to evolve. Whether that is a small adjustment or a big one, we don't know. But the rules will evolve. And I would say, for folks that have never borrowed money before, just watch closely before you take out that first loan and try to devise a strategy, and then understand that you need to recalibrate. The one thing that I think is the most legislative risk or executive order even would be the SAVE plan. Right now, it lets people file taxes separately and exclude a spouse. It includes a complete subsidy of unpaid interest, and it multiplies the poverty line, which is part of the formula to get to the payment, multiplies it by 2.25 instead of historically 1.5. I think that there's a risk where the SAVE plan could revert back to feeling more like a revised pay-as-you-earn, where the payment would be a little bit bigger. The interest subsidy is there, but smaller, and you cannot exclude spousal income. I think pay-as-you-earn in and of itself is going to be there. That was from Obama's first term. Revised pay-as-you-earn still seems like it would be a viable option if SAVE reverted back to it from Obama's second term. But the SAVE is a big budget item, and I could see that being a question mark for a future executive order if enough studies are published about the real cost to the government to allow SAVE.
So I think just thinking about the various different programs, a lot of people are currently having to re-enter payment, especially last month. So when someone gets off and actually has to start repaying, what payment are they automatically defaulted into, or from there, what are they automatically on board for? Not, for those that haven't already chosen one, and also for those that have, did they just go back to their previous choice, even if the program itself has changed?
So if somebody was in revised pay as you earn, they're being moved into save. If somebody was in pay as you earn, they're staying there. IBR, old IBR, ICR, pay as you earn, whatever. If someone's standard, if someone's in a plan, that's ultimately where they stay through the resumption. The big difference is revised pay as you earn is automatically changing to save for families. If someone's first entering repayment, the expectation from the servicer is going to be that they're going in with a standard repayment, which is a 10-year amortization. And then they can, when they enter repayment, they can go through the process. Sometimes if you're a resident or a fellow, if you are medical, you want to consolidate your debt as soon as you're done with med school. So payments can start at the beginning of residency for PSLF. But when you're going through the payments launching, when you're first entering into this for the very first time, you can actually apply for an IDR, income-driven repayment plan. And that's where all these acronyms and alphabet soups come into play. When you're applying for it, the process will include some education around here's this option, this one, and this one. In my own experience, reading the rules is a little different than applying them. So sometimes getting some help and thinking through the chapter 2, 3, 4, and 10 of student loans can be helpful. But when you go through the application for an IDR, it will actually tell you you're eligible for SAVE. Here's how it works. You're eligible for pay as you earn, and here's how it works. And so even though it may suggest that you're defaulted into the standard, you're entitled to go ahead and fill out the application for income-driven repayment and tackle your loans with a different approach.
So speaking of different approaches, we're talking a lot about, well, here's this one program that could potentially save you on interest, or hey, here's this other program where the government might waive your fees, et cetera, et cetera. But let's just say someone says, hey, I took out this money, let me try to pay it back as soon as possible. What are some of the strategies that you've seen work pretty well, and what are some of the options?
Sure. Well, Empo, my financial coach, and we actually talked about a case recently where there's a large amount of student loan, well over even averages for a physician, let alone national averages. And so if someone wants to pay them off, I still recommend that they learn a little bit about the federal programs and the subsidies. And I'll give an example. If your income-driven repayment was, a certain dollar amount every month, but the interest rate on your loan was, we'll pretend 6, and your loan was $250,000. Okay. You're facing in a given year, you're facing what, $15,000 of interest. And let's pretend that a refinance was going to get you to 5. It's going to be really tempting to pull that trigger and say, I'd rather have, a 17% less interest due. But if that person's payment is only $500 a month, under the SAVE program, any unpaid interest is subsidized by the government. So that person essentially paid $6,000 in interest, whereas on a refinanced loan at 5% on $250, they would have paid $12,500 of interest, right? And that same person could have taken the rest of their budget. Maybe they could have afforded, if they wanted to pay it off, they could have afforded paying $1,000 or $2,000 a month. They can take the rest of their budget and just tuck that money off to the side until the next time their income's recalculated, or the next time. And once that person has a very clear pathway, which shows that their income-driven repayment under SAVE is going to force them to pay all the interest and then start hitting principal, then they might liquidate some of that savings or money they held back and make a big payment on the loan and then tackle it. So even when someone says, I want to take the bull by the horns and pay these off, there are absolutely examples out there where if the loan balance is sizable enough, the interest subsidy is going to be meaningful enough that it's going to take what looked like a 6% loan and maybe make it feel like a 3-year or 4% loan, which is still better than a lot of refinance options. And quite frankly, is a path of less resistance to repayment. So I will say there's still value in learning about the SAVE program, even if you're planning to rip the Band-Aid off.
And so kind of just going into that discussion of, well, let's talk refinance. Does it ever make sense then to refinance, or are government programs, especially if you have federal loans, is that kind of the best path currently for most borrowers, or what are you seeing here?
So there are plenty of case studies where refinancing makes a ton of sense. So first and foremost, there's a lot of private loans with variable rates and a lot of private loans with high interest rates. And if we're able to look at somebody's credit score and talk about their debt to income ratios, very often refinancing is in their best interest. There's also a lot of examples where if somebody were, I'm going to pick on a dentist, okay? If a dentist wants to buy a practice, the bank underwriting the practice loan might come out with an assumption that 1 or 2 or some percent of the loan is the monthly payment. And that, if a dentist has 400 or 500 of student debt, which is realistic in dentistry, that could be a real swing in terms of whether that loan's getting approved and whether it's getting favorable terms or not. Whereas if that dentist needed to, they could do a 20-year refinance, and the actual obligated payment, regardless of what IDR they would have been in the federal government plans, and regardless of how great those could have been for savings, a lot of banks that are lending money to do a dental practice acquisition are still going to go back and say you were paying 1% or 2% in their formula. So a 20-year refinance is significantly less money per month. It is locked in, and the bank will take that as the actual amount being paid, and it's easier to qualify for that loan. And then, of course, there are examples where somebody's at the point, maybe it's a couple years into repayment. There's going to be examples where they've just out-earned the ability to benefit from these subsidies. So if I'm in SAVE, but my payment more than covers interest, there's no interest subsidy. So I may as well go get whatever the best rate out there is. Could be a refinance, maybe not. If somebody's close to loan forgiveness via public service loan forgiveness or a long-term program, then that's where refinancing may be off the table, because a private lender is not going to give you the same forgiveness opportunities that the federal government does. So examples where I wouldn't, but several examples where I would consider a refinance. And hopefully interest rates get a little bit better, so refinancing can feel, more and more profitable or opportunistic. But we have seen folks even in the last couple of months get offered rates that are better than what they had federally.
Well, Chris, I wanted to thank you very much for your insight here today. As all of our listeners at home can probably take away from this, every situation is going to be different. Things are changing all the time and fast. So if student loans are of a concern, I would say that here at My Financial Coach, we have experts such as Chris who are ready to help. And also just beyond that, just looking through, knowing that you have resources out there, and we hope that all of our listeners have enjoyed. Thank you for being on the show, Chris.
And but thank you for inviting me. It's my pleasure.